You work 60-hour weeks, save lives, and what's your reward? A tax bill so big it makes your student loans look friendly. Welcome to the reality of being a high-income professional. But don't worry, today I'm going to show you how to legally reduce your tax burden and keep more of your hard-earned money. For those of you new to the channel, my name is Jazz. I'm an Australian-trained radiologist currently based in London. Now, before we get going, full disclosure, I am not a financial professional. Make sure you do your own research as well. Alright, first up, let's break down how doctors get taxed in Australia. If you're earning over $180,000 a year, you're in the top tax bracket, meaning 45% of your income above that goes to the taxman. Add the Medicare levy, add potentially the Medicare levy surcharge, and suddenly half of your income is gone before you even see it. So how do we legally bring that number down? One of the easiest ways to reduce taxable income is by maximizing deductions. Here's a quick rundown of what doctors can claim in Australia. Firstly, you have work-related expenses, which could be, medical equipment, scrubs, professional memberships, AMA, your specialty college, etc. And then self-education, which could be CPD courses, conferences, or other subscriptions. Next, home office deductions. If you do telehealth, research, or admin from your home, you can claim part of your internet, electricity, and home office setup. Next, you have car expenses. If you drive between hospitals or clinics, you may be able to claim some of the mileage. And lastly, income protection insurance. If you pay for it yourself, it's tax deductible. If you're unsure whether something is deductible, just ask yourself, did I buy this because I'm a doctor? If yes, there's a good chance that it is deductible. Unless it's a yacht, then probably not. But always check with your accountant if you're unsure. Now, if you're a salaried doctor, one of the easiest tax saving hacks is salary sacrificing. You can contribute up to $27,500 a year to your superannuation at a reduced tax rate of 15% instead of your marginal tax rate of 45%. That's an easy way to bring down the taxable income while saving for retirement. Next, let's talk about one of the biggest tax game changers, your work structure. Are you an employee, contractor, or running your own practice? Each comes with different tax advantages. Now, for employee doctors, you get limited deductions, but you are still eligible for salary sacrifice and basic work-related expenses. Then you have contractors and private practice owners. You can structure as a sole trader or a partnership or even a company, which allows more deductions and tax planning strategies. Lastly, you could consider setting up a trust. Many private practice owners set up a discretionary trust to distribute income to family members on lower tax brackets, reducing the overall tax burden. But again, run this over with your accountant and see if it works for your situation. And remember that this applies to human family members. Unfortunately, the ATO won't let you pay a salary to your dog. Now let's talk about negative gearing. Australia has one of the most investor-friendly tax systems in the world, and doctors can benefit from negative gearing. If your rental property expenses, for example, these could include loan interests, maintenance fees, etc., exceed the rental income, you can offset the loss against your taxable income. This lowers your overall tax bill while your property ideally appreciates in value over time. And as a bonus tip, if you're buying property, consider setting up a self-managed super fund to invest in real estate, which comes with huge tax benefits. Just make sure you get professional advice before doing this. Another smart way to pay less tax is through investing. Australia's tax system rewards long-term investors through franking credits on dividends and the capital gains tax or the CGT discount if you hold assets for more than 12 months. So what are franking credits? Well, if you invest in Australian stocks, you receive tax credits for the company tax you have already paid, meaning you get a tax refund instead of a tax bill. Then you have capital gains tax or CGT discount, which is when you sell an investment after 1 year and you only pay tax on 50% of the gain instead of the full amount. So if you invest wisely, you can truly set yourself up to keep more of your hard-earned money and set yourself up financially. At the end of the day, the tax laws are complicated and doctors have pretty unique financial situations. A specialist medical accountant will help you structure your income, maximize deductions, and ensure you're not overpaying. They're essentially the financial equivalent of a specialist physician, definitely worth the investment. So there you have it. Whether you're a junior doctor, radiologist, or a surgeon, these strategies can help you keep more of your money and build real wealth. So another quick recap. Number 1, maximize tax deductions. Number 2, use salary sacrificing to lower your taxable income. Number 3, consider your work structure, employee versus private practice. Number 4, invest strategically with negative gearing and franking credits. Number 5, work with a specialist accountant. If you found this video useful, hit that like button, subscribe to the channel if you're new, and I'll catch you in the next one. Cheers.